G'day, Ziggy here, author of Money Does Grow on Trees, and welcome to episode 3 of my podcast, Plan to Prosper. Now, in today's episode, what we're going to be covering is the relationship between risk and return. What does risk mean? Everyone's got a different view on risk. We're going to be introducing this concept of what I call the poverty trap. And as usual, we're going to finish off with a question or a myth that we want to debunk. But before we begin, I want to get into a joke, right? We always start with a joke. Now, it's from my book. This one is by Helen Gurley Brown. And she says, money, if it does not bring you happiness, will at least help you be miserable in comfort. Now, the one that we like to use is that if I'm going to cry, I'd rather cry in a BMW or a Mercedes than a Holden. All right, let's get into it. I found a quote years ago when I was researching for my book, and I put it in the book, and the quote is, your priorities will determine if you achieve your goals. 90% of retirees have worse cash flow in retirement than in their early 20s. Now, that's a good segue into this concept that I have called the poverty trap. What do we mean by that? Well, look, it'll come up on the screen in a second. It'll also be in the show notes. The poverty trap is basically it's a concept where you start off in your early 20s. Let's say you've left school and you've begun working. You may have gone to university and you graduated and now you're working. So there is some strong cash flow. If you haven't moved out of home yet, maybe you're not paying board or a lot of board, then you have some good, strong cash flow, right? And what tends to happen is at some point you move out of home, maybe you partner up, you get married, you end up somewhere either paying rent or you've purchased a property and therefore you've got a mortgage and now you're into your early 30s. And then from there, what tends to happen is you may have start a family, the children comes along, maybe you go from double income to single income, you've still got the mortgage. So there's a lot of expenses in these years in particular, and therefore there's not a lot of cash flow surplus. There's not a lot there for wealth creation. And then what tends to happen is that as you move from the 30s and maybe into the 40s, the kids are growing up, there may be school fees, there's holidays, you're still paying off a home loan. There's all these sorts of expenses. And at some point, the kids, start to grow up and they start to form their own way and their own journey. And now you're into potentially your 50s and maybe they're leaving home or they're maybe still at home, but they've got their own income and maybe most of the home loan is paid off. And therefore you now have more by way of more surplus income. So there's more cash flow, right? But you've still got to pay off your home loan and maybe you're still doing a bit of traveling and you still have other expenses. But then you get into sort of your mid-50s, maybe later 50s, maybe the loan's paid off, and now you're saying, gee, I've got this stronger cash flow now, but here I am within 10 years of retirement and I don't have enough, right? So that's called the poverty trap. And then what happens is that two things will happen. One is you either have to continue to work for a lot longer than what you plan to, or you just have to get used to living off a lower of income. Because if at that point maybe you have some superannuation, maybe you've invested in a property and you've developed some equity in that, so you have some net equity, some net money that's going to pay you an income stream, but maybe it's not enough. Maybe it's not enough to the amount that you've become accustomed to. And so this poverty trap just says that as you go through the process and the cycle of life, if you haven't made provision for wealth creation, then you'll get towards that sort of 50s and 60s and you just won't have enough. And so you end up in this trap because maybe you've lived a decent life, but you've never put money away, you've never invested money, you've never contributed extra into superannuation, and therefore you end up into retirement with less money than you had when you were in 20s, less surplus money, okay? Which brings me to the point of, well, how much do we need? Now, I get that question a fair bit. How much do I need? Now, if you're needing a certain amount of money and you don't have enough assets at retirement or at a time when you want to be financially independent, then as I said, you're going to have to work for longer. But the aim is, and the message from the poverty trap principle or the concept is about starting early, right? It's about starting early. It's about doing something. It's about doing something. It's never too late to begin. But the message is start doing something earlier. And so I've got, we've got our children. We've got a boy and a girl. Nathan, our son, has begun working. He's an electrician. He's got some money. He's still living like a good Greek boy. He's living at home. He ain't moving out till he's 40, but he's still living at home. He's earning an income. And I sat him down and I said, listen, you're earning some good money at the moment. We're not charging you any board, but either you start to contribute to the household expenses or you start creating some wealth. And so he ended up buying an investment property. We certainly assisted. He wasn't able to do it himself. And another podcast episode, I'll cover how parents can assist their 20 or 30-year-old, well, not 30-year-old, but in your 20s, in terms of helping with some wealth creation. So we assisted. He's slowly paying us back. There's a few things going on there. But he's now investing, has an investment property, and so he's now contributing to that. He's paying that off, and he's still living at home. We're enjoying his company. We love having him at home. And so he has now begun, right? He's begun that process. He's begun early, even if it's a little bit, right? It doesn't have to be an investment property, but even if it's putting money into superannuation, even if it's into a savings plan of some sort, or a managed fund, or a shared type of portfolio, whatever the amount is, it is important just that you start with an amount that you're really not going to miss. And that comes back to managing of your cash flow. And with our daughter Naomi, what I did with her was she doesn't have an investment property yet, but we sat down with her and said, okay, what's your income? What is the money that's coming in? How are we going to allocate that money? How much is going to go towards giving? There's an amount. I encourage our kids to give an amount. So how much is going towards giving? How much is going towards saving? How much is going towards investing? And how much is going towards your living expenses, your car and other, going out in restaurants and that sort of thing. So whatever it is, you need to plan, right? We're talking about plan to prosper. So at any given point in time, you do need to do some planning, and this is where a financial planner can help you with some planning. There's plenty of even information online. Everyone's got a different idea. We've got the Barefoot Investor. Like he's got a great book. He talks about management of cash flow. So there are lots of good people around who can give you some guidance. It's a matter of getting that information, saying, how does that apply to me and my scenario? And a good financial planner will work through the goals and objectives and sort of put that all into place for you. So the message is start early. Also, it's never too late to start. So if you're sitting here and you're thinking, well, it's all well and good for your children. I'm in my 30s. I'm still renting, or I'm still living at home. Whatever the case, it's still a good time to start, right? Start with something. Your strategy is going to be different to my son and my daughter's strategy, who's going to be different to maybe someone in their 40s who maybe had a business or had a job and lost it, and now they're left with nothing. Okay, so a good financial planner will be happy to navigate and put a plan in place. So plan. As part of this, when you're planning and when we're talking about creating wealth, we need to talk about this concept of risk. We need to talk about the concept of risk versus return. Now, when we're talking about risk, the minute that you hear, even now as you're listening to that word risk, there's certain connotations, right? There's certain things that are coming into your mind. There's a certain feeling immediately that you go, oh, risk, oh. If you're risk assertive, which means you do chase growth, assets, and risk, you go, yeah, I'm happy to take on some risk. But if you're very conservative, then even that word is going to conjure up some feelings like, nah, I don't want to take any risk. But we need to have this discussion because you may have a false understanding of what risk is, and therefore a false understanding of the relationship between risk and return. So let's have a chat about it. Now, when we talk about the word risk, usually people will start to talk about, shares are risky. Shares are risk. I don't want to invest in shares. I don't want to risk. Property's the way to go. Bricks and mortar. And yes, there's a lot of truth in that. Both carry risk. So when we're talking about risk in this concept of investing, when we're talking about risk in this concept of wealth creation, what we're talking about is the level of volatility that you encounter when you invest. What does that mean? Well, it just means that what's going to happen is that when you invest, right, if you put your money in the bank, you're probably just going to get this over time. But if you invest in either shares or an investment property, you're going to get a bit of this, right? Over the long term, both those asset classes will grow, but they are volatile. Okay, so if you invested $100,000 into a share portfolio, you're investing because you believe that in 5 years, that $100,000 is going to be worth more than it is today. But because of the level of volatility and because of the change in the value of share prices, what happens is that 100,000 tomorrow could be worth 98,000. It could be worth 102,000, right? That's called volatility. That's just called the movement in the value of those assets. Property is exactly the same. If you invested in a property today and you bought it at auction, now we don't do this, but if you did then have another auction tomorrow to see what you could get for your property, if you paid $700,000 for that property, if you take it to auction tomorrow, you may only get $650,000. You may also get $750,000, right? There's no guarantees, and this is that volatility aspect. Now, if you put that same $100,000 I was talking about, the share portfolio, if you put that in the bank, tomorrow it's going to be worth $100,000. The next day it's going to be worth $100,000. The day after that it's going to be worth $100,000. Oh, and wait, there's a dollar in there, extra dollar in there, so it's going to be $100,000 and $1. So there's no volatility, but there's not a great return either, right? Now, when interest rates are high, then therefore the income return is obviously going to be good. So when interest rates are about 5 or 6%, that tends to be the rate of return when you're putting money in the bank, usually a little bit less. But when interest rates are very low, then the income return, the interest income return in a bank account is going to be very low. And then when there's inflation and then when there's tax, there's no real growth in that money, because what happens is that you've got that money that's invested in the bank, it earns an income return, but there's no capital growth. So if we go back to shares and property, when you're investing in shares, there's the dividend that are paid on shares. So there's the income component. And then there's the value of those shares that do fluctuate up and down. Obviously, over the long term, you want that to go up. And history shows that blue chip shares do go up over time. In property, it's no different. You purchase an investment property, you've got the person that's renting it off you is paying you rental income. That's the income component. But there's also the capital growth on the underlying investment, okay? And so we have these two components of a return on the shares and the property that you don't have with cash, because that cash, all it delivers is an interest income return. There's no capital growth. Now, cash has its place. There's no doubt about that. And maybe cash is a good place to park your money for a period of time. It's a good place to have maybe some buffer if you're needing to have, say, 3 months of living expenses to cover yourself. But if you're investing for the long term, if you've got a long-term horizon and you can invest for 7 years plus, then really it's the growth assets like shares and property where you should be investing. Now, bringing it back to that poverty trap, right? It's important that you start early, because when you're investing in shares or property, it's the sheer weight of time that will carry you through. Because if you get to your 50s and you haven't invested and you start then, it is never too late. But if you haven't started early enough, you've missed a few property cycles, you've missed some share cycles, so you have missed some opportunities. And so it is important that you just start early, and that comes with some good planning. So coming back to that risk and return, the risk is when you're investing in property or shares, the risk is this level of volatility, okay, where the movement of the capital amount that's being invested is going to fluctuate. So if you're a conservative type investor, then you can't really handle too much of that volatility. And therefore, the majority of your investments are going to be in what we call defensive assets. Defensive assets are cash, fixed interest, like term deposits, government bonds. And again, like that cash example, they provide a solid capital foundation. There's not a lot of growth in the long term. You're not going to get fluctuation. You put $100,000 there, as we said, it's not going to drop down to $99,000, but you're not going to get a lot of capital growth. But there is a component of your overall wealth that should have some exposure to these defensive type assets. If you're a high growth investor, then the majority of your assets are going to be sitting in these growth assets, and these growth assets are shares and property. When it comes to shares, it's going to be Aussie shares, international shares. So you do want to get exposure when it comes to Aussie shares, for example, into the big banks, big insurance companies, all these large, Wesfarmers that owns Bunnings, all these large companies that make billions and billions of dollars, all the ones that we complain about, all about the banks, right? We complain about the banks. A broker that I'd met in the 90s said that if you want to get back at the banks, just buy their shares, because you will make lots of money as they make even more and rip us off. Now, so you want to invest in Aussie shares. When it comes to international shares, good to have some exposure to big international companies, the Amazons, Google, Apple, because that gives you some spread, right? It gives you diversification, right? And that's the way that you reduce risk. When you spread your assets, you don't have all your eggs in one basket. And then when it comes to property, again, property is one of those things where, it's a lumpy asset. You're putting a lot of money into the one property. So it is careful that you get good planning advice and consider a property purchase within your overall strategy, right? So it's a lumpy asset. It's big. And yes, it grows. If it's a good one, it obviously grows in value. But just be mindful that it's not, if you're needing money all of a sudden, you can't go selling the kitchen to get $50,000, for example. So just be mindful of the lack of what we call liquidity in property as well. Now let's bring in return, right? And see, okay, this relationship of risk and return. So we've talked about risk. We've now got a level of understanding when it comes to risk. How does that relate to return? Because we all want returns. We're all chasing returns. We need returns so that when we get to our retirement age, we've got returns on our investments, and now we have a capital amount that's invested, and that can now deliver an income stream. Well, the returns are going to be different, right? They're going to be different for different asset classes, and we want to maximize our returns but minimize our risk. That's the ultimate aim. We want the maximum returns, but we want to try and minimize that risk. Now, the relationship between risk and return is that they're correlated in the same way, which just means that as you increase your level of risk, you increase the level of return. So if you don't want to take any risk, you can put your money in the bank, your return's going to be low. If you want to increase your risk and invest in shares or property, then over the long term, the return's going to be high. Can you lose your money in shares and property? Absolutely you can. Because in that scenario of the auctioning off of the property or those shares, if I invest in shares or property today, tomorrow it's likely that it will have a different value. So that means I need to have a long-term horizon. I need to be investing for today, but with a view in mind about what that investment is going to be worth in 7+ years, at least 7 to 10. Because what if I invest today and all of a sudden there may be a terrorist attack, there may be a recession, whatever the case is, it's going to have an impact on my investments. I need to be able to ride that out. I need to be able to even have an opportunity where I can invest more when those markets have maybe dropped in value. So I can't be in a position where I've got 100,000, for example, and I say, look, I'm going to need that 100,000 in 12 months' time. You can't go investing in property or in the share market. That is high risk. You may get a high return, but actually it may be a negative return, because if you end up having, we end up entering recession or something happens, then the value of that 100,000 in 12 months might be less. It might be higher, but actually might be less. So if you've got a shorter term horizon, if you have some cash and you're going to need that money in 12 or even 2 years because you want to purchase a property, you're going to need it for a car, whatever the case may be, then you really shouldn't be investing it for the long term. Now, there's all these get rich quick, and you can go into, I'll use the example of crypto or whatever it is. That is high risk. In some cases, it's not even high risk, it's speculating. Okay, so when you buy something or invest in something today because you're hoping that it's going to double by tomorrow, the next month, and the next year, that is high risk. In fact, you're speculating on what's going to happen. There may not even be an underlying, investment sort of fundamental, amount in there or concept, right? So just be mindful of the risk and return and your time horizon. So the longer time you have, the more you should be investing in growth assets, and understand that the more you invest in growth assets, the greater return over time. What if you don't invest in growth assets, or you don't invest enough in growth assets? There's another problem that's looming, and that's the risk that you won't have enough. See, when we're young, we don't worry as much about it. It's superannuation. I can't have access to it. Forget about it. It's too far away. I don't even think about it. When you're 20s, it's like 60, 50. Man, they're old. I'm 52. I was 20 once. I used to think that 50-year-olds were old. I'm old. But it comes around so quick. And so you need to make provision for it. You need to start. And then what happens, as I said, you get into your 50s and it's like, oh, hang on, I'm probably not going to have enough. Now there's another risk, because you didn't take that risk early on, because you didn't start even with just small amounts. Now there's this risk of, I'm not going to have enough. What does that mean? Well, that means I'm going to have to keep on working. I'm going to have to become accustomed to not of living off a lower amount. Okay, so what impact does that have? So you need to be thinking about which risk you're prepared to take on. Now, you might say, well, I don't want to take a lot of risk on now. And if that's the risk that I need to deal with, longevity risk we call it, if that's the risk that I need to deal with, I'll deal with it. But most people don't want to deal with that risk, because when we do get older, trust me, you start to feel it more compared to when you're 20s, and you start to feel more vulnerable. And if you don't have enough, then that's going to start playing some mind games on you. So it's important to start early. Longevity risk is an issue. I was just talking with a few boys this morning in terms of, I might die tomorrow. Yeah, okay, well, that's true. We might die tomorrow, and therefore you want to live life to the full as long as you're living it. But the balance of probability says that as males, we're typically going to live to 83, 84. Females tend to live, I don't know why the females always live longer, maybe. I don't know why, but there you go. They tend to live a little bit longer, a couple of years longer than us males do. And so on the balance of probabilities, we're going to be around for a long time. So if you're looking at being financially independent, if you're saying, look, I want to know that I've got enough when I turn 60. Okay, I want to be able to travel before I get old. Okay, so if that's your point, then you've got another 5 years of ensuring that you've got enough assets that are going to generate an income stream to cover your living expenses and everything else that you want to do in retirement. And so when we're talking about, there's a difference between retirement and financial independence. So retirement is when I actually stop working. Financial independence is a point in time where I can wake up in the morning and say, today I'm going to work, not because I have to, but because I want to, right? That's a real empowering position to be in, because you have the choice as to whether you work or not, okay? And so we want to have a goal and be at a point and aim for a position that says, by the age of 60, I want to know that I'm going to be financially independent. And I may continue working part-time. I may continue working full-time, but at least you have that choice. Which brings me to this concept of, or this question, if you like, of how much do I need? How much do I need? Well, most people don't know how much we need, right? No one's really done their numbers. Sorry, when I say no one, a lot of people don't do their numbers. They don't know how much they need to survive. And one of the things so let's unpack that a little bit. How much do I need? Well, let's use today's figures. So if you had no debt, if you had children and they were off your hands, so there's no responsibilities there, in today's dollars, how much would you need to cover groceries, all expenses around the home, maybe some traveling, restaurants, whatever else is the case? Let's say you needed $80,000 a year, right? And we call it net of tax. Don't worry about the taxes. Take that away. So there's no debt, no children, no expenses there. $80,000 a year is going to cover you maybe for some traveling as well. So what we know is that wherever your money is invested, either property, shares, or even if it's in cash, doesn't matter whether it's inside superannuation or outside, let's not worry about what the structure of it is. We know that we can get around about a 5% income return over the long term. Now, that being the case, if I need $80,000 a year, the amount that I need to have invested is going to be about $1.6 million. Now, remember, that's excluding our home, because your home will never give you an income stream. You need somewhere to live. So when we're talking about financial independence, in order to have that 1.8 million, because remember, if it's 10 years away or 20 years away, we need to adjust that figure with inflation, then you may need to downsize. You may need to accept a lower amount than 80,000, because what if you only have $1 million or the equivalent of $1 million? And in today's dollars, that's only generating $50,000 a year. And you might say, okay, well, that's going to cover all expenses. But if you want to travel, it may not cover traveling. You may not be able to cover if you want to go see a movie or some of these extra things. So it is important to plan and know your numbers when it comes to this regard. The final thing that I think you should be looking at is the risk of not having your finances set up efficiently. What I mean by that is, if you're a super fund, if you're an expensive fund, there's high fees. But if you're in a fund that maybe doesn't have high fees but has low returns, if you're in a fund and it's not invested in the way that you want it to be to achieve those level of returns, then it's inefficient. It's not working as hard as what you're working. And so we want to make sure that everything is being reviewed. We want to make sure that we're reviewing your tax is being reviewed. We want to make sure you're not paying more tax than you have to. Right? We're not talking about evading tax, but we are talking about minimizing tax. And the other thing is, even if you've got an investment property, maybe you can get more rental income than what you're currently getting. If you're not, that's inefficiency. So everything that we talk about is about being efficient. Everything about is achieving a return within a level of risk, within your risk profile. And we want to make sure that you're investing and you've begun, so that you don't fall into that poverty trap, so that you don't end up at age 55, 60 or 65 with not enough money. So the message is, start early, start now, get yourself a good financial planner and plan to prosper. Thanks for joining me on episode 3 of my podcast, Plan to Prosper. And until next time, we'll see you soon.